Hello, I've come to St Paul's Cathedral, which is right next door to the London Stock Exchange in the City of London. I'm going to talk about one of the most difficult things about investing. How do you, as an investor, keep faith in what you're doing amidst all the uncertainty and ups and downs of the stock market? The trouble with investing is that it's a long-term process. You won't really know that you're doing the right thing for 10, 20 or 30 years until you retire and turn your savings into a pension. So, how do you keep yourself on track? The unfortunate reality is that humans aren't designed to be great investors. We tend to remember the pain of our losses far more than the pleasure of seeing our money grow. This makes us slow to respond to opportunities and prone to giving up when things get difficult. We're not helped by the fact that when the FTSE 100 does occasionally tumble hundreds of points in one day, it makes the news. We're told hundreds of billions of pounds in value have been wiped out. We tend not to hear the news that the FTSE 100 has performed extremely strongly and created even more money in the preceding months. So, tip 1, keep your eye on the bigger picture. If you make 20% and then lose a couple of percent, it's not so bad, is it? And second tip, diversify, spread your money around. Other stock markets may do better than the UK. It's hard to tell in advance which those will be, so invest in several and hedge your bets. But the biggest problem with investing is timing. Most people are reluctant investors who wait far too long before putting their money in the stock market. They wait until all the news is really good and they're convinced they're not making a mistake. The trouble with that approach is that it leads people to buy when markets are high and to sell low when they're disappointed when markets fall. Obviously, buying high and selling low is a guaranteed way to lose money. What you really want to do is buy low and sell high. But that takes guts and resilience. For example, it means investing in 2009 even though everyone is talking about the banking crisis and how broke the country is. At that point though, the banks have been bailed out and the worst of the crisis for the stock market is over. Most of us aren't investment saints who do the virtuous thing and buy at the bottom of the market. Many of us are reluctant investors who, after we have finally started to invest, immediately start to worry, did we buy too high? Will we lose our money? For you, this chart will give some reassurance. In investment, time heals a lot of wounds, but it can take an awfully long time. For example, if you'd invested in the UK stock market right at the top of the dot-com bubble at the end of 2000, this chart of the FTSE 100 shows the sort of returns you would have got over the next 13 and a bit years. This is the sort of chart that people use when they say investing in shares has been a disaster in this century. It's certainly been tough. 3 crashes, lots of anxiety and opportunity to spare and pull your money out too soon. But if you had held on, you would have got a 61% return today or turned £1,000 into £1,600. That's not a great return, but it's a reasonable one. Even though you invested at the wrong time, you've got a real return on your money, beating inflation of 35%. Ultimately, that's what investing's about. It's the same story with the FTSE World Index. Investing in the developed world was also tough if you started at the 2000 high point. The interesting thing though is while shares in companies did badly, their bonds did well. This corporate bond index has grown 126% since 2000. Shares in companies in emerging markets did even better, with total returns of 211%. Gold did best of all, up a stonking 441%. The disadvantage of that chart is that it's backward looking. Those areas that did well in the past 13 years may do poorly in the next decade. Investment is cyclical like that. Those areas that did poorly may do well in future. To recap, there are 3 principles to successful investing. 1. Buy low and sell high. Second is diversify. Spread your money around between different asset classes and countries. And third, hold on for the long term. The good news is that while the first can be difficult to do in practice, if you stick to the other 2, you should come good. I hope that helps you keep the faith.